Today, we're going to talk about the hidden profit mistakes in your business, or the hidden flags of things that realize you're not profitable, things that most people don't talk about. We're going to talk about the importance of understanding how your numbers are laid out. We're going to talk about the importance of knowing your magic ratio and why that matters. We're going to talk about why you're probably not profitable and the things that you're stressed out about and what you can do to fix it. I'm Dennis.
And I'm Greg.
And this is the More Profit, Less Stress podcast,
where we provide the tools for more profit and less stress in your business now, so you can turn into a valuable asset later. Welcome to the More Profit, Less Stress podcast. I'm Greg Forzani here with Dennis Taekema. Dennis, I don't know about you, but I think most of the small business owners I bump into fit this description. This is ridiculously common and probably describes most small business owners. They feel like they're healthy, life's good, they're paying their bills, they're able to get a vehicle, life's okay, right? It's good. They make 75 to 150 grand a year, although by the day that's becoming less of a good living. And they just don't realize they're not actually making a profit as an owner, and they're not building an asset that one day they can sell. And before we kind of get into this, I want to go on a rant. You know, if you're a small business owner and you're only able to make a fair market wage or less for the job you do in your company, why do you own the business? And, people will say, because I love what I do. Well, that's great. If you love what you do, give it away for free. And then the pushback is, right, exactly. The pushback is, I can't give it away for free because. Okay, so then you own the business because you want to make a profit, and you would love to be able to sell that business for a valuable asset at the end, or some kind of, and I don't mean just asset value, but sell the business for an amount of money at the end you retire on. And the sad thing is only 2.5% of business owners are actually ever able to accomplish that. And that's crazy. And that's, I think why today's subject is so important. It's us raising, and you and I came up with a list of 8 of them, but 8 things that are signs that these people, they don't own a healthy business. It's not actually profitable or going to be worth something one day.
Well, I think part of it is people get weird about money, right? Like the amount of trades guys I've talked to who will make like $35 an hour working somewhere and then go, $35 an hour is low now, but let's say even $50 an hour
Right.
Working somewhere and doing the job. And then they go, I'm going to go start my own thing because the boss is making $150 an hour, $160 an hour, whatever it happens to be. And I'm only making 50. Obviously he's making way more than I am. I should go out and only charge $100 an hour, and I'll take more business from that guy, and I'll get busier and I can make it for myself. And then they get weird about what actually something actually costs to deliver to the marketplace, or they decide that they're going to sell it for something, but they're emotionally insecure about the price. And so they don't really know what's going on. And people just get weird about money. Like they look around what their social circle is, and if they want to fit within a certain dynamic, and all of that psychology pounds into the business and leaves a lot of things that are massive warning signs that you're just not going to be profitable or get to that spot that you're talking about of, I want to retire one day and sell this thing one day.
And we've had, just for those listening, before we get into the 8 reasons, we've literally had 3 clients in the last year actually, sell their businesses for assets plus goodwill. And the goodwill is profit times a multiplier of a number of years. And actually those 3 sold for somewhere around 10.5 times profit, 7.5 times profit, and about 4.5 times profit. And now we have a literally going through the process right now, and they're going to sell for very close to 5 times profit. All of those plus assets, which means these business owners built companies where they made more than $500,000 a year in their pocket just from profit. But then they're also able to sell the company for millions at the end. And that's, if you're going to be a business owner, you're going to put up with all that bullshit. That should be kind of the goal, right? I mean, I'm not taking anything away from love what you do, and whatever industry, product, service you're in, love it, have a passion for it. That's awesome. But unless you're independently wealthy, you can't afford to do it for free. And I don't know what you're like on this, but for me, honestly, until I reached about the age of, I'd say maybe 50, you just kind of always think retirement's this thing way in the future. I'll deal with that when I get to it. In my 20s and 30s, it was that's way down the road, right? That's forever from now. But man, the minute you start getting closer, 50 might be the number, you start thinking about retirement. You start thinking about, okay, what am I going to do there? What's my retirement going to look like, and what's going to fund it? Well, if your house is your biggest asset, that's great. Except then to live a nice retirement, what do you got to do? Sell your house and go live in a condo? which
Well, and
by the way can happen, but the business can fuel that retirement so you can still live in your house and enjoy it.
Well, and real estate's so subjective. Like when I look at the history of real estate in general, yes, housing prices increase, but they seem to increase in or around the price of inflation just in general.
Yeah, totally.
Like, so you may have bought a house in the 1970s for 30 grand and you might be having it listed for $500,000 today, but look at what a dollar could have bought you back in the 1970s. And so then a lot of people say, well, I'll put my money into government savings plans or mutual funds or the stock market or whatever else. But unless you're a really good stock trader and you know what's going on, it's hard to make a really high return on that. Yes, some people do, but most don't. And the one investment you can control and you've got the most control over is usually the one that's the most neglected. And that's the business that you're building. And the reason why these businesses are selling for such high multiples is because investors are looking for businesses that have high returns. They're not looking to buy something that's like you and a truck. And once they separate you, it's just a truck. Like you got to think about the whole dynamic of the thing. And a lot of businesses don't even own the real estate they operate out of. They lease that from somebody else. So if I'm going to go sell that business, so just as an example, I was having a conversation with a gentleman, and it was a really funny conversation because he was under the impression that I was there to buy his business, and I was under the impression I was there to help him build his business. And so it took me about 45 minutes of conversation to figure out that we're not on the same page. But he ran this welding company building a custom product. And I got to talking to him about how much he wanted for the business. He said, well, I want $500,000 to get out of this business. And I said, okay. So
because
of that
$500,000,
yeah. So I said, for $500,000, I said, do you own the property? He goes, no, I rent the facility. I said, okay, so I'm not getting a facility. I said, how new are your tools? He says, well, most of my tools are over 15 years old. They've been around for a while. I said, okay, who does most of the work in the fabricating and that kind of stuff? He goes, well, I got a staff, but I still do most of the fabrication and I still do most of that. And I said, okay, what about your sales team? Who handles most of the sales? He was like, well, I also handle most of the sales and I do most of the invoicing, but I've got a bookkeeper that handles that other stuff on that end. I said, okay, that sounds okay. How much did you pay yourself on average? He goes, well, I pay myself around 60 grand a year to do all of this. I said, okay, how many hours a week do you work? Probably about 60. Okay, how many vacations have you taken? Well, I think my wife and I took 2 weeks last year. I said, so the entire time you've been in business? He's like, yeah, I mean, I'll take weekends off once in a while, but I've only really had a real vacation for about 2 weeks. And I said, okay, so just so I can summarize, you want $500,000 where I can make 60 grand a year. I've got to be the full-time fabricator with some staff. I've got to use old tools. You've got no building that I can leverage as an asset. And I'm going to trade that all away for 2 weeks of vacation every 20 years.
What were the tools worth?
He goes, I have no idea. Let's just say it's $100,000 worth of tools, right? I said, so for $500,000, I'm buying myself a prison for the next however many years. He goes, yeah, it doesn't sound too good.
You're getting $100 grand worth of tools and you're getting a $60,000 a year job
with no vacations.
Yeah. So you're paying for a job, which nobody on planet Earth would want to do. Why would you want to pay for a job? That's crazy.
But that's where most businesses end up, right? Like they don't have the asset to leverage. They don't have any real estate to leverage. They just have what they've been doing for a while, and what they've been doing for a while has no proprietary value. And that's where most of these guys end up. And that's why we want to talk about the things that most people don't talk about to know whether or not you're not profitable. So you got to get your psychology in order, but also what are you looking for and what do you know how to fix? So we're going to get into that today.
Yeah. Okay. So number one reason, and it's not like these are in order.
Chronological order.
Yeah, exactly. There's just 8 reasons. So number one, and you actually it's a good segue. You just got into it. The number one sign is the amount of money you're able to put in your pocket as an owner is not more than a fair market wage for the job you do. So the welder explanation is perfect. Like he's making 60 grand a year, which probably isn't even a fair market wage for a welder. I would think they're going to make more than that. Like, well, for sure they're going to make more than that. So if you're to hire a welder as a wage, I mean, probably between 75 and 125 grand a year, give or take. So he's not even making a fair market wage, which means for sure he's not making a profit. And, for the listener, this is a super easy exercise to test, and just use the welding example Dennis just gave. So you take that example you just gave and say, okay, so he's got his P&L, and in his P&L, he may or may not have that 60 grand in expenses or cost of goods, right? Like it might be zero and it might be 60 grand profit, or he might have the 60 grand in expenses or cost of goods with zero profit. But the point of the exercise is super simple. Run your P&L, look at how much money you pay yourself in expenses or cost of goods, and adjust that number to a fair market wage. So in the case of the welder, the adjustment, let's just say it's 100 grand. would be, I should have paid myself $100,000 as a welder. So it's $40,000 more than I paid myself at 60, which means you got to lower your profit by $40,000. And in his case, then profit would have been negative 40. Super easy exercise. And probably literally the number one indicator we see, number one sign we see.
Well, and most people will say, well, I don't pay myself a wage. I pay myself dividends, or I pay myself this way, or pay myself that way. Well, what we're saying is, if you look at your profit and loss statement that you get back from your accountant, you take what you paid yourself and you put that as an expense. Is there actually any profit left over? Because you can pay yourself dividends without making a profit. It's just a transaction on a ledger. So what's the actual number? And if you increase that number to something you'd actually have to pay somebody else to do that work. We see this all the time. By the time you run that, there's no real profit left. And if there is, it's like a small single-digit percentages. We're not talking about anything healthy enough to survive off of.
So for clarity, you're saying, because you're right, people go, well, I pay myself a dividend. For clarity, number one, a dividend is profit. Like that's not actually in expenses or cost of goods in a P&L. So you're saying if they pay themselves a dividend, go back and look in their P&L of expenses and cost of goods, they paid themselves zero, then they got to add that $100,000, which means they got to reduce profit by that $100,000 and see what it looks like. Because again, for definition, dividend is just how I take the profit out.
Mm-hmm. Well, and a lot of guys will go, I'll pay myself what's left over, whatever that number is.
Yeah, right.
Right. And that's where it gets calculated as a dividend. So you're paying yourself left over, whatever that number is. So just for clarity, when you're thinking about a business, and Greg touched on this already, every single position inside of a business has to get paid for a business to be viable. I don't know anybody who's going to come work for you for free and take whatever's left over. The owner is the only one who will work with himself for free and take whatever's left over. Well, we're saying that leftover amount just needs to be structured as an expense and not as a leftover amount. And you'll find out, is what was left over enough? And we're only talking here about one position. If you're also the bookkeeper, and you're also the sales guy, and you're also the janitor, well, all those positions inside of the business need to be covered too. So if I'm the chief welder, janitor, all of this stuff, I got to go back and put in numbers, figurative numbers into my expenses that cover a janitor salary, a bookkeeper salary, all of that. And if I do all of that and there's no profit left over, I have a real problem.
And for clarity, we would say, like in your welder case, he's doing welding, sales, you said, right? Invoicing, all that stuff. So say bookkeeping, internal bookkeeping, sales and welding. The internal bookkeeper would be a part-time job. Making this up right now, but let's pretend that's $10,000 a year to pay somebody part-time to do that. Salesperson, maybe in his case, is part-time because he's welding. So again, let's just say that's 30 or 40 grand a year because they're part-time. And then he's welding maybe full-time because maybe he's working 60 hours a week. Then a full-time welder is 100 grand. So then he's got 100 plus 40, say, for sales, plus 10 for bookkeeping. Like it's 150 grand worth of wages that if somebody owned the company and didn't work in the company would have to pay the 150 grand wages. It's a big deal. And actually, sorry, go ahead.
I was going to say, if you ever watch Shark Tank or Dragon's Den, you notice this. They ask the questions of the people doing the pitch. Did you pay yourself last year?
Right.
Yes or no? And the answer is yes. Well, how much? Did you pay yourself after profit? If the answer is no, they ask these foundational questions and you watch the body language of the investors shift depending on how you answer. So if you claim profitability, I made 10% last year on $1 million. Great. Did you pay yourself? No. It changes the entire negotiation.
You see the pen in their little book go.
And it changes the offer. So the number one sign that not number one, but one of the signs that you're not profitable is how you pay yourself and whether or not you're allocating that to an expense.
Totally. And we actually kind of merged number one and number two. Number one in theory is you're not even able to pay yourself a fair market wage. So the welder, as an example, probably should have made 100 grand or maybe 150 if he's working part-time as sales and stuff, but he's only able to pay himself 60. So that's the number one sign. Number two sign, and we covered that as well already, is you don't make a profit after that fair market wage adjustment. So you make that adjustment we talked about and profit is a negative number or zero. So that's top two. Or first two. Third one, again, these are not in any particular order, but this is super common. We see this. You talk to somebody and go, hey, how's business? Whatever. I'm healthy. I'm doing well. And you say it's a restaurant or whatever, an office building, whatever it happens to be, a warehouse. And you're like, how's business? Good, making this. And I own the building. And maybe it's because the business has been around a really long time, or it's a generational business. Something happened where they're able to buy the property or own it. And they say, yeah, I own the building. And then you ask the question, well, as the building owner, do you charge yourself a fair market rent for the space, for the building? And they're like, no, the business owns it, so I don't need to charge myself. Okay, so that business needs a space to operate. It needs a space to function. So let's pretend fair market rent is $6,000 a month. I'm just making a number up. Typical small business rent. So if you went into your expenses and made that $6,000 adjustment, now what's your profit look like? And so pay yourself the fair market wage, do the adjustment we already talked about, and make a fair market rent adjustment. Are you making a profit? I don't know about you, but most people I bump into, I find once they make that rent adjustment, they're not making money. And then that kind of goes back to the investment part, right? If you're going to be a building owner, that's a different discussion, different investment than the business owner. Like you should get a return on that building ownership, right? It's like owning it's like owning a house and letting your kids live in it for free. I mean, no judgment. Go ahead and do that if you want, but that doesn't mean the kid's successful because they're getting rent free, right? Like how would the kid be doing if they had to pay rent?
I tell clients to look at it from a perspective of replacement cost. If you lost this location and you had to go pay rent somewhere else, is the business still viable?
Yeah, exactly.
If the answer is no, because I'm too dependent upon this rent, we have to make some corrections in what we're doing. So even like, I've got clients who are farmers, right? And so we're organizing things like selling meat. Well, Dennis, my cattle's really cheap because it raises on pasture all the time. And start off from a calf, I'd have no real input cost to grow this animal, so I can charge less. And I go, okay, that's great. But what happens if we run out of supply and we have to go to the market and buy supply? If I got to go replace these animals with market animals and I'm no longer viable, then my business itself isn't viable. So it's the same thing with rent. If I'm just pushing the money through and hoping to make up those savings on the back end, well, your business isn't really viable because you're not being honest about the entire transaction.
Right. Yeah, I think I think actually from my experience, like we've been doing this a long time now. I'm just trying to think. I think almost every single business that I've worked with or started working with where they own the building, I don't think any of them were ever charging themselves a fair market rent for the building they were operating out of, which they owned. They all pick a rent where their accountant's like, oh, choose this number for tax reasons, which by the way, we're definitely not saying like choose your numbers for tax reasons. That's great. But you have to do that hypothetical adjustment to make sure the business is viable. Like you said earlier, that's a biggie.
Well, and it affects all of the decisions. Like I've got no problem, by the way, with anybody paying themselves less rent. I think it's great. If you can save the expenses, I think it's a great move. It's a good market move. I think there's some good advantages there. But you can't calculate your business's viability off of that, because if anything were to happen and you got to get rid of that building for whatever reason and you got to relocate somewhere else, or someone's going to buy that business from you and they can't make comparative rent, you're no longer viable. So you got to build everything around viability and then work the numbers after that. But you got to start off with, will this work in a different circumstance?
Totally. Actually, you can even add to that. That's a really good point. You can add to what you just said and say, okay, so you go to sell the business, you own the building and the business, and the buyer of the business wants to buy the business and you want to keep the building, right? Because it's a retirement investment. I can live off the rent in retirement and I want to rent it to them. So are you going to want to rent it for fair market price, or are you going to want to give them, 75% discount or 50% discount because they're nice people? Of course, you're going to rent it for fair market price. So there's your flag right there. Like if the business isn't going to be profitable once you got fair market rent, now you got a problem. So that's a great litmus test, what you just said. Yeah, love it. Number 4, you can't afford to upgrade your outdated equipment or tools. You can start on this one because you just gave the welding example. Like that's a perfect example.
It's the same thing. So when we talk about profitable pricing, we take into consideration what I like to call the magic ratio. Every business has a magic ratio, and the ratio is revenue to COGS to expenses to profit. Your ratio is going to be different than somebody who's in a very big, busy metropolitan area or a very small urban town. So it doesn't matter if you're the same industry, your ratios are different. So if you're taking a look at your ratios, is my business only operating because I'm running on really old equipment And if I got to make any kind of changes, I have no money left over to make these changes because I can't afford the new payments. I can't afford to release. I can't afford to whatever. And if you're always playing that game of, yeah, I'll keep using the same old drill, but I've duct taped it together because it works just fine and I'm too scared to go buy a new one. You got to evaluate that in your overall business structure. It's one of those things where I personally believe that every business should be run like a peasant so the person can live like a king. I think you should run things on the least amount of money possible. But that doesn't mean you should be running on a starvation method. You still have to be able to feed the people to do the thing. I told my wife it's like slavery. I never understood slavery from the perspective of I'm going to starve my slaves and beat them all the time and expect them to work. It doesn't make sense to me because their production's going to drop in the old days. Just like I wouldn't run a tractor and not do any maintenance. I wouldn't skip oil changes. I wouldn't skip greasing. I wouldn't skip any of this stuff because the overall viability of it's going to drop. But if I can't afford the maintenance, well, that's a hidden profit problem. I'm not making enough money.
Yeah, totally. Love it. And I guess just to add to that is, and then, so when that piece of equipment, we'll say dies, for lack of better words, and they got to buy another piece, which you don't necessarily have to buy new, you could buy used, to your point about run on the proper, what you can afford, right? So you go to buy another piece of equipment and A, you don't have the money to buy it. So that's a sign you're not making profit. Or B, you got to get a loan, like finance it, right? So you go to finance it and the lender's like, your financials stink. You're not making a profit after fair market wage. So we're not taking the risk. So those are all big signs and problems that just go back to you're just not making a profit. And if you got especially if you got equipment that's aged, like if you have a truck or tractor, whatever it is, right? Scanning machine, whatever it happens to be, a big printer, whatever it is. If you've been using it for a really long time and it's gotten to the point where it needs to be replaced, that means you've been in business a really long time. Like you've been in business for 10, 20, 30 years. And when that time passes, if you still can't afford to replace it due to wear and tear, like that's a big sign you're not making a profit. You're just barely making enough to live the lifestyle you want to live, which is probably just some kind of wage. Yeah, that's a really good hidden one.
I helped a client buy a competitor's business. The guy was, not really a competitor. The guy wasn't wanting to go out. He wanted to go out, sell and move. And he wanted a premium for his equipment and he wanted a premium for his database. He wanted a premium for everything. And when we sat down and negotiated, there wasn't a single piece of equipment that we looked at and went, this is better than what I have. It's worth me paying you a premium for this. So like, if you're eventually going to go sell this thing, does anybody coming along even want your stuff?
Right.
Or are you going to be going to a pawn shop to try to get 10 cents on the dollar or throwing it into a bulk auction trying to clear it off? Because if you can't afford to replace it, they're not going to want to buy your gear anyway. So you got to build your financials. And yes, you don't want to manipulate your actual financials. You want to do pen and paper exercises on a different piece of paper to figure out what's going on. But you got to be able to build in replacement costs and all of this stuff. Now, there is a strategy. I've had clients where we've looked at leases of equipment are coming due to go lease a brand new piece of equipment. Well, we can evaluate, is it make sense or not make sense? But you have to have the budget to be able to do it if you need to.
Yeah. Agreed.
There's an epidemic no one's talking about. And right now, that epidemic is the fact that 90 to 95% of businesses are failing. And I want you to think about that for a second. That means 9 out of 10 people who start a business or buy a business go out of business. So now, if you're a business coach, or maybe you're even thinking about a career change and you want to start business coaching, there's something you need to know. Most business coaches think their biggest problem is getting clients, and they're wrong. Their biggest challenge is keeping clients. And you want to know what keeps clients? Financial results. Not breakthroughs, not clarity sessions, not feel-good kumbaya stuff, but cold, hard cash. And here's the proof. You see, we track the cumulative results across every single client in our program, and 94% of the people using our curriculum pay themselves a fair market salary as well as a very healthy net profit. That's 94% of them. And we're fighting this epidemic, and we want your help to make a real difference in small business success around the world. That's why we're licensing our proven curriculum to coaches, mentors like you, and advisors who actually want to get their clients paid. If you're interested in learning more, you can just simply click the link below.
Number 5, you can't afford to expand or buy struggling competitors. So great segue, because you just said you had a client that bought a competitor or bought somebody else in their industry.
Yeah, the guy wanted 6 figures. We bought it for 16 grand.
Which, before you expand on that story, that actually proves everything we're talking about today. Like what you just said proves this whole message, which is the guy wanted over 100 grand or whatever the number was because blood, sweat, and tears. Like, Dennis, you don't understand. I've worked really hard at this and I worked nights and missed kids' ballet practice and soccer games or whatever. Didn't get to go on holiday, so it's worth a lot. But to the buyer, that's not the case, right? Like you do a really bad paint job, but you take a nice vehicle and put a really hideous custom paint job on it, the buyer's not going to care how much time you put into that or what you spent on it. If it's ugly, it ain't worth anything, or it's worth less, right? So that was a great example. So the business actually doing the right calculations turned out to be worth $16,000. That's a massive eye opener / reality moment that I think a big part of the reason why we have podcasts like this is, I think, the stats say 95% of businesses fail. And the definition of failure is they go bankrupt or they close. The vast majority of those close versus go bankrupt. And only 2.5% sell for more than just the assets, like the equipment, which means that there's a lot of businesses when they go to get out, that reality hits them right in the face that, wait, I thought my business is going to be worth whatever, and it's worth very minimal. And by that point in time, it's too late to go back in time and change or fix. Like
it's scary to fix now, but it's better to be scared now than end up with nothing later. And most end up with nothing later.
Yeah, absolutely. Yeah, I mean, we can expand a bit on that. Like, but bottom line is if you have a business, you use equipment, whether it's heavy equipment, vehicles, trades tools, clinic equipment, whatever it happens to be, a restaurant, like cooking apparatuses,
the amount of places you can go to buy used kitchen equipment because these kitchens couldn't sell. Like it's
exactly.
I've got a friend of mine who built a very popular sushi restaurant for 10 cents on the dollar because he bought everybody else's liquidated restaurant equipment.
Yeah,
it happens all the time. Ritchie Brothers is insanely busy up here in Canada, and I think they're in the States too.
Super
and they've
busy.
got massive sales
facilities
everywhere.
Yeah,
and the amount of people that are just liquidating.
I just think back to just a simple example. My wife and I had a pet store. She operated it, but different podcast, different day. And I think we've already done one on this, but gross margins. She would analyze the gross margin percents by department, brand, category, et cetera, made some decisions, wanted to shift the product mix. In that decision was we're going to carry less kibble and carry more frozen raw food because the margins are better. Plus, it's better for the actual pets, which fit the concept of her store. So great. Okay. What do we got to do? We got to carry more frozen raw food and less kibble. Well, what do we got to do that? We got to buy frozen raw food. Wait a second. It's going to melt in 3 hours sitting on the shelf. We need freezers. So she had to go from 4 doors to 11 doors. Well, if that store wasn't profitable, we wouldn't have been able to do that. Like if there was no profit, it would have been how do you afford another whatever,
I go sell
7
more.
doors.
I go sell more of the stuff that doesn't sell because I haven't looked at everything.
Yeah, exactly. So there's so many companies, I'm sure, face that situation and just go, well, I can't afford to, or add a new service, right? Like you have a clinic or a trades company and you want to add a new service, or you got like, we have a client that does backyard saunas, like barrel and cube saunas, and he's expanding like crazy. And he's like, I need to go buy another picker truck. Well, those are expensive. And he was able to do it like no problem because he's super profitable. So yeah, if you want, just think about opening new territories, adding new services, whatever it is. And I think to your point, I love the idea when people go to grow like that, go look for used stuff that companies who are failing or have failed are trying to dump or offload. That's an awesome way to do it.
Well, and I think as we're talking about things like I think we led into this with you can't afford to buy struggling competitors. If you know your numbers and you know what's going on and an opportunity comes for sale and you're not profitable, you're missing out on so much easy money. Like the reason why this client bought the business for 16 grand was because the way we brokered the deal. We didn't need his equipment because we looked at our numbers. Our equipment that we had was better. And if we did need something he didn't have, our current operations could already handle the extra expense of adding in that piece of equipment. We took a look at what he actually had that was valuable, and he said a lot of things. And then when we took what he said and we put it down to, okay, well, we'll build a deal around what you said, but we're going to put some accountabilities in there. And one of the things was, how do I just get into his database and take over these customers that he had? And by the time it was said and done, we paid commission for the database, and we paid commission per transaction, first time transaction. It worked out to, we had to pay him 16 grand. So we bought an entire...
there wasn't even any money up front.
No money up front. We were paying it on a monthly basis with full accountability, all legally taken care of in the contract. and we worked it all through. And there's so many opportunities that are out there for people that have got nothing of value except for a contact list, a marketing list. And if your business isn't in a position to even afford to do that because you're worried about making the bills now, it's a hidden profit flag.
We'll do another, we'll do it. We should do a whole podcast on that subject. But yeah, to your point, and this point number 5, like we're big proponents of, if like the number one marketing strategy a company can do is literally buy a struggling either competitor or complementary business. It's massive. The opportunities are huge, and they're always going to be there because 95% are failing, struggling. So it's kind of easy to do, but you can't do it if you don't have the money. It's kind of like when the real estate market crashed in 07 or whatever it was, those who had money bought a bunch of properties and then either still own them and rent them out, or they flipped them and made a pile of money. Those who didn't have money couldn't do it. It's no different. But the cool thing with business, like, I don't know what I still bump into people because I live in the States. I still bump into people like, oh yeah, we bought this thing in 07 and this was a great, we benefited from it. Or others are like, can you imagine if we had the money and we could have bought this thing in 07? I hear it all the time from a real estate perspective. And every time I hear it, I think to myself, everybody looks at the 07 real estate crash as this unicorn opportunity that happened that some people took advantage of, some people missed. But in my head, I'm like, that unicorn opportunity exists every single day in business. Every single day, 95% of businesses are struggling. You just got to go find the ones that are either for sale or are so fed up that when you bring it up with them, they'll sell. Like, and you got to be profitable to be able to do that. Anyway, we should do a whole podcast on that because that's a big subject.
Oh, we could do an entire topic on how to buy a struggling business. And there's lots of them that are out there. And for people going, well, yeah, that's my path. I'm going to go buy a bunch of struggling businesses. Okay, but if you don't understand your hidden profit leaks, you're not going to have a very easy time.
Yeah, for sure.
Buying another business.
And the lender's not going to lend you money when you go, well, I'm going to go buy a struggling business because I'm doing well. And the lender says, show me you're doing well and take your welder. Here's my P&L. You're only putting 60 grand a year in your pocket. That's not even, like, you can't even pay. Like, what happens when you go buy this other business and you got to do work there? You're going to pay a welder 100 grand to do your work. Now you're losing 40 grand. So lenders aren't stupid. They figure that stuff out. Yeah. Number 6, profit only shows up on paper at year's end versus building cash throughout the year. Okay, tricky one. Can talk about this a few different ways, but I think the big one is at the end of the year, it's up to you and your accountant, mostly the accountant, I guess, to get creative with your books to figure out how to show a profit or not a profit, when you're expensing, depreciating stuff, how much you're depreciating, all that kind of stuff.
It's your accountant's job to make sure you owe the legal amount of tax on what you actually owe. That's what they're going to be doing. So the way they structure that is going to be important for you to have a conversation with. When I look at this, and I think Greg does too, it's what's your operational profit? Do you understand how to make the company profitable every single month? So when you're looking at your operational financials, now there's tax deductibilities, there's all that kind of stuff that goes into taxable profit. For me, operational profit is, do I have the cash flow after everything is paid to put some money aside? That's operational cash flow. And that balance should be growing every month because I know, okay, I have not spent all of my income on stuff. I have stuff left over and I can slowly build up that pool. And I've had clients who've been like, they've spent every dollar all year and they operationally spent every dollar all year. Then tax time comes and they get this big tax bill. They got to go, well, I wasn't expecting that. Well, that's where you're supposed to be having the conversations with your accountant as you go along as well. So I just want to be careful when anybody's listening here. I'm not an accountant and I'm not a tax lawyer. You got to have those conversations with those professionals. What I am going to tell you is you're responsible for your operational numbers, not them. You have to know what's going on.
Yeah. And actually for those, so 2 things there. One, we do understand there are businesses that are seasonal. So there are some businesses where there's months of the year you're not going to make a profit, but then you got to make enough profit in the other months to compensate for it. So we do understand that. We're not
and
naive
you have
to
plan for that though.
Yeah,
that's what you're trying to say though.
Yeah, exactly. And then the second thing is, I would just say to those people trying to figure out, plan how much tax they owe at the end of the year so they don't get that surprise. Our profit plan tool does that for them. Like right at the very bottom, it tells them every single month how much money to put aside for income tax. So by the end of the year, you don't get that bam. And I know there's a bit of a diversion, but it's kind of an important subject and a huge benefit. So many business owners are stressed at the end of the year when they get that big tax bill. Where it gets really actually stressful is if your profit's going up each year, because your accountant's job is to say, hey, Dennis, last year you paid 50 grand in taxes. So this year plan to pay 50 grand again. But the accountant doesn't have a crystal ball to know how much profit you're going to make this year. You're the one that knows that. So our profit plan tool actually at the bottom helps you when you build that budget, track it every month, spit that number out. So if you double your profit, you're going to owe like 100 grand, well, maybe more than 100 grand in taxes because you
Depending on brackets.
You got your accountant says put 50 grand aside. You put the 50 grand aside, you go buy a new boat. And then it's like, and you weren't ready for it. So you can't blame the accountant on that. That's the business owner. They got a plan for if things are improving, I'm going to have to pay more tax, or you're putting that money aside, right? That's a huge deal.
Well, and we've had clients who understand how their numbers in their business work, go back and have conversations with their accountant, and it changes their tax situation because they're presenting a way better picture of what the business actually does, where accountants rely on tax code, and they also deal with volumes of clients. Like I tried to say this to one of my clients, when you look at how much you pay your accountant, and you break that down hourly, how many hours do you think your accountant actually has to spend on your file? And how many clients do they need to make a business that's profitable? They don't have the time to be the expert on every single individual client's financials. They just don't have the capacity. So the more you know your numbers and the better position you are, you can ask better questions. And then you take those questions, you get better answers. Those answers turn into better decisions. Just most people are busy handing off the pizza box of receipts at the end of the year and not finding out what's actually going on until 6 months after year end when they do or don't get a tax bill.
Yeah, totally. Number 7, no emergency money in the account. And we kind of touched on this already a little bit, but yeah, like I guess the very simplest example is 2020. 2020 went bam to just about every business on the planet. And those who had no emergency money in the account, done. Sad, pisses us off to no end. Like how do you build an emergency money fund? You got to make profit, and you got to pick a number and say, I'm always going to have this. I'm always going to have my operating line, but I'm always going to have this liquid or money sitting in my account or whatever, easily liquid, and whatever that looks like.
One of my favorite lines on our financial profit plan tool that our clients get access to is the cumulative let profit line, because being that I'm in Canada, most of my clients are trades and I specialize in that industry. Everything in that industry for the most part is seasonal. And I've got a client right now who's in a location in Canada where all of the stuff happening globally is having a pretty big impact on what his business is doing. And we've been able to ride that cumulative net profit line, take a look at some of these months where we're expecting reduced income, look at the income magic ratio between income and expenses. Yes, he's going to operate at a loss, but we can predict when the turnaround is going to be, and he's not stressed. He knows, okay, I've got this much cash in my emergency fund to hold me over. Now, what most people do is they look at the cash in the bank account and the brain goes on a fritz and says, I can go spend this money. And they decide to upgrade tools or go expand something or go change something, not planning for where that emergency fund has to go. And when we work with clients, our goal is 15% net profit or better after everything is said and done. And when I talk to people about this, I look at it and say, well, if you make $1 million a year, and you make 5% net, that gives you 50 grand, right? Overall. So if I'm making $1 million a year, that means overall I got to be bringing in $84,000 a month in revenue. And if I'm only making 5% on that $84,000, it leaves me with $4,000 potential profit at the end of a month. Well, what happens if I got one bad month and I've only got 50 grand in that emergency fund? I'm screaming. I got problems. If I run into month number 2 and it's also a bad month, I'm now running to banks, I'm begging high interest lenders, I'm doing all kinds of things for somebody to give me the cash to cover my overhead. So I do a very basic, rough thing. Well, if I make 5%, I can't survive 30 days. If I can make 10%, I might be able to survive 45. I could probably push the first month halfway through the second month. If I can make 15 or better, I can buy myself 90. And why do I say 90? Because it's not very often you're going to have 2 bad months that are straight down in a row. And if they do, even 15% is going to save you. It generally goes down and back up again. 15 buys me that cushion of where to spend it. Yes, the tax man's going to want a part of it, but at least I've planned for where that money's going to go and I can see it through the financials, and then that drops my stress. I can plan around it.
You're making me think back to point 5, buying struggling businesses like buying competitors. Just imagine if a business is really profitable and they're able to make 15% net, say, of revenue after paying a fair market wage, and they're able to stockpile some cash. Imagine a scenario like 2020 comes along, or 2007, or whatever the next one's going to be, and economy shrinks a bit for 3, 6, 12 months, and a whole bunch of businesses hanging by a thread start snapping and going down. If you're that business that's making really good money and made really good money, you got a stockpile of cash, what an opportunity to grow. And I mean, come on, the people with money, they know this, they play this game. When economies, I think probably more than half the time, economic downturns are forced, they're intentional, because then these businesses struggle and they just suck them all up. Super easy. So what a great opportunity for those who have. And by the way, even if you make really good money and you don't have a huge stockpile of cash, when you go to a lender and say, I want to buy that company over there that's struggling and get it really cheap, the lender's going to lend you money because you got a great track record. Massive. Like, not only is being profitable build emergency fund insurance policy, it's an unbelievable bullet in the chamber for when times go tough to be able to grow market share really quickly.
Well, and it's recessions that build big businesses.
Right.
Like, and that's why I say to clients, learn to operate your business like you're a peasant so you can live like a king, because it gives you the chance to run the numbers, to stockpile some of that cash. Because when everything's going up, everybody thinks it's not going to change. When everything's going down, everyone thinks it's not going to change. But when you learn to run the market trends, like your family business, the FGL group, they grew off of recessions. Talking to your dad specifically about this, like, we would wait for market downturns and we just come in and start buying stuff at 10 cents on the dollar. And then when the market
didn't even need market
again,
downturns, they were all struggling anyway.
Yeah.
I think it started with market downturns and it became a realization that all of them were struggling. So just one at a time, buy the next one, build up cash flow, stockpile, buy the next one, build up, buy the next one, build up. That's all it was. Grew from one store to 450 stores doing that. Just bought up everybody in the whole country. And that was the exact strategy. It's not rocket science.
Because everyone's struggling.
Actually.
And you can only do that if you know your numbers and can spot the hidden profit leaks.
So there's our 8th point right there. You just said it. You got to know your numbers. But the 8th red flag we're talking about, or sign, is you dread looking at them, right? Like it's you're in business 5, 10, 15, 20, 30 years, whatever. And you believe things are going well because you're making, you can pay your bills, you're making a profit. You think you're making a profit. You're just like Dennis's welder story. The guy's making 60 grand a year, not able to pay himself a fair market wage. And then those kind of businesses kind of dread looking at their numbers. They don't want to, well, they probably don't track them well enough to be able to look at them every month.
That's
they're
part
probably
of the big problem.
Yeah, quarterly or semi-annual or annual with the bookkeeper or accountant. So there's a flag right there. If the only numbers you're looking at are your financials from your accountant or bookkeeper, and you're doing it once a year, once every 6 months, once a quarter, massive red flag, because you don't know what's going on. You got to look at them. You got to look at them regularly so you can make decisions. But when you go to do that, if you're dreading that moment, deep down, you know yourself, it's not working.
Well, and to be honest, the way your P&L is set up is written around tax code. It's written around certain tax numbers, and it's written around things. And there's categories inside of your profit and loss where your accountants puts things specifically for the tax code. And in Canada, I can take a look at it and I can say, well, here's a classic example. It's management fees as a tax number. Well, that management fees is also professional fees. And professional fees can be lawyer, it can be marketing company, it can be business coach, it can be bookkeeper. They can put a lot of stuff into one category. And a lot of tax code numbers are written to put lots of stuff into specific categories. It's how the government sees things. Well, if I have a large number in a category that I don't understand, well, then I don't look at my numbers because it's just confusing to me. And so what do we look at? We look at the top number, and then everything below that top number feels like blah, 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 blah. And then we take a look at the bottom number. And if that bottom number isn't a positive number, it just causes stress. And so it becomes easier to say, well, I'm going to look at my bank account and hope there's enough there. Because every time I look at my financials from my accountant anyway, it just stresses me out. I don't feel like I'm doing all that well, and I don't know what I'm looking at, and it feels overly complicated and all of this stuff.
And then they think the solution is, oh, well, I just got to do more revenue.
Well, that's what your accountant will tell you too. If you're not making enough money, go sell more.
Yeah, totally.
Well, sell more of what?
A good way to think about this, looking at the numbers thing and being stressed, is like school, right? If anybody's a parent and the school phoned the parent and said, okay, new school year, you, the parent, have two choices. Number one, we can give you access to an online portal. On that portal, you get all test scores, attendance, assignment scores, like all the report card about everything about how your kid's doing in school. You can look at it anytime you want live. Option two, we don't want to stress you out. Like, that's stressful as a parent. So don't bother looking at it. We're not going to share anything with you. And when the whole year's done, in the middle of summer, when you're on vacation trying to relax, we're going to send you the final report card. Every single parent, you would think, would pick number one. And that's because they want to be able to make decisions and make changes and get tutoring and, take their kid out of this thing and put them into more studying and stop playing and doing this or whatever it is so they can affect the report card and get better grades. Nobody wants to see it at the end. They all know this. But if you change the word from report card or kid to business, a lot of parents, a lot of business owners pick number two. It's crazy.
And I think part of the challenge too is where people decide to become competitive, right? Like, yes, I can make changes on my kid's scorecard, but there's excuses I can make around that. Let's say sports, right? Like I had a lot of fun going to one of my friend's kids' hockey games, and he's in that couple of levels below the NHL yet, but he's getting good. And I'm sitting there in the audience and I'm realizing there are already scouts coming out to find the 1% of these kids to take them to the next level. And like, this kid's good. And then when you realize when you get to the NHL, like, people don't know every player in the NHL. They know the 1%ers of the 1%ers of the 1%ers. Well, how do you get there? You focus on improving individual competitive skills. Some people spend hours slapping a puck. Some people spend hours catching a puck. And then the game goes from just, I got to put the puck in the net, to a whole game of strategy and chess and all of that. Well, now imagine you guys are watching the NHL and you don't get to find out who won the playoffs until a year after the playoffs were over, and you had no idea how well the teams were doing during the entire season.
Yeah, exactly.
Would you watch it? It's the exact same thing. I'm just bringing that for the people that don't care about school.
Or would the players even want to play in it?
No, don't worry, guys. It's just about having fun. We're going to go out there and we're going to go play to have fun. That's why we do this. No, everything's competitive. And in business, it's just as competitive. And it's your job to understand your scorecard and to know what decisions to make. And I can say this emphatically. Every single client that we've ever brought on board walks into it numbers blind in spite of education. And when we break it down from this is your tax numbers to this is your operational numbers perspective, we break things down to, okay, let's rip apart categories where things have been lumped into and break them out into easily understandable categories. And we understand where each individual line item is going. Even if they're not making profit, I watch their stress drop, because they know where they're at in the game. And then within 90 days, we can reverse almost every problem depending on the size of the business that we find going through that process, where most people dread looking at them because they're like, well, it's just going to tell me that I'm dying and I don't want to know when the last day is. Our clients go, yeah, I'm stressed, but the numbers tell me I'm okay. It gives them a different perspective. So if you dread looking at it, chances are you're not profitable, and you're just, every time you do, it creates anxiety and you're freaking out. Learn to play the numbers. Don't get played by the numbers.
Thanks for listening to the More Profit, Less Stress podcast. If you liked what you heard, be sure to subscribe or follow on your favorite podcast platform and leave a comment or review if you're feeling generous. To learn more about us and what we do, check out our website. Until next time, take care.